video is sponsored by My Property Stats, the all-in-one toolkit for real estate investors. The cap rate that you buy a property on really does not matter. I bought 0 caps, I bought 1 cap, and I bought properties with negative NOI, literally properties that are losing money. And so the cap rates in those circumstances are liars. And I'll tell you why. What is a cap rate? If you've been investing in real estate, you know that a cap rate is NOI divided by cap rate equals a purchase price. Or if we go out and we buy a property and we did not put any debt on it, the cap rate would also be our cash on cash, meaning how much money we put into the property divided by how much we get annually, and that is gonna give us our cash on cash. So quick example, income minus operating expenses equals NOI. The reason NOI is a very important metric is because a lot of different kinds of real estate investors exist, all the way from huge pensions and life insurance companies all the way down to somebody who's just trying to buy their first investment property. So we use NOI to equalize how a property is valued, because the pension funds and the hedge funds and all these huge people can get a lot better debt terms. They can go borrow money at 2%, really long amortization schedules because they have a ton of money, versus the other end of the spectrum, somebody who's just getting started, they might have to pay a 6% interest rate just because they're inexperienced, because they don't have a lot of money, they're viewed as more risk. The NOI divided by the cap rate is going to give us the value of that property. Okay, so let's take, for example, we have income of 100,000, we have expenses, operating expenses of 100,000, and that gives us an NOI of $100,000, right? 200,000 minus 100,000 equals $100,000. And so if we were to say value that on a 10% cap rate, we would take the $100,000 and we would divide it by a 10% number, right? And what that would do, 100,000 divided by 10% comes out to $1 million. So a property that produces $100,000 of NOI on a 10% cap rate is worth $1 million. Well, let's say, for example, that was a mobile home park, right? In kind of a smaller town, it presented more risk, so therefore the cap rate was 10%. If we move over to, say, a big multifamily complex in a great market, let's say, it's downtown Dallas, Texas, growing market with a lot of great industry, this investment type is viewed as a lot less risky. And so what that means is that investors are willing to buy this and earn a lower return, because you have to remember that return rate and risk are directly correlated. The higher the risk the asset, the higher the risk the investment, the more you expect to be returned, right? So something that's lower risk, something that's guaranteed, is gonna have a lower rate of return, and that's also gonna indicate that it's gonna have a lower cap rate. And so the mobile home park might have a 10% cap rate, but let's say we have an apartment complex that has the same exact numbers. Let's say it has $200,000 of income, $100,000 of operating expenses, and a $100,000 NOI. Well, that property may be valued on a 5% cap rate, and if we do $100,000 divided by 5%, that's gonna give us a $2 million value. And so literally the price of one of these is double the other, even though at the end of the day, they produce the same amount of income. And again, it's tied to risk. That's the basic 101s of cap rates, right? But what most people don't understand is that the cap rates are actually a liar. The cap rate that you buy a property on really does not matter. I, in fact, don't care at all. I bought 0 caps, which means there is 0 NOI. I bought 1 caps, which means, if I bought a property for $1 million, it was only producing $10,000 of NOI. And I bought properties with negative NOI, literally properties that are losing money. And so the cap rates in those circumstances are liars. And I'll tell you why. Whenever you're buying projects, there's 4 different kind of projects. Number 1 is a turnkey project. Number 2 is stabilized. Number 3 is value add. And then number 4 is gonna be a development or a redevelopment project, okay? If you're buying a turnkey property, then the cap rate matters. If you're buying a stabilized property, then the cap rate matters. But where I like to invest, where I think that you should invest, and where a lot of people make real wealth inside of real estate, is through value add projects and development and redevelopment projects, okay? And so let's focus on value add for this conversation. If I go out and I buy a property for $1 million that has no NOI, and I know that I can get that NOI to $200,000, let's say I can get the income up to $300,000, operating expenses at $100,000, and it produces $200,000 of NOI, and that property is on a 5 cap, Well, guess what? That property is now worth $4 million. So do I care that I bought this on a 0% cap rate or a negative cap rate or a 1 or 2% cap rate? No, I don't care, because the NOI today, the NOI that is in place is different than the NOI that I'm going to have this property produce in, say, 1, 2, 3 years, right? And so the other mistake that I kind of see people make is that whenever they're buying a property, let's say we're out on LoopNet or Crexi or wherever we're at looking at commercial real estate, and we see a property and the property is listed at a 5.24% cap rate. Okay, and we go through and we analyze the property, we go, okay, 5.24%. And you go and you analyze that property and you think that you're gonna add all this value at a 5.24% cap rate in the future, and that's the analysis you use, right? You say, hey, I'm gonna add value to this and then I'm gonna resell this property on a 5.24% cap rate. The thing to know is that 5.24% cap rate is kind of made up. If it's that specific, it is a made up. All they've done is essentially say, hey, our NOI is X and we want $7 million for this property because that's what we want. Okay, what does that cap rate equal out to? And so these cap rates, they're making them up. Whenever you're buying a property, the in-place cap rate is not the cap rate you should use to value a property if you're looking at, hey, I'm gonna buy this property, add value and sell it, or I'm gonna refinance it, and I'm just gonna sit on that equity forever. You still wanna know what that property is gonna be worth at the end of the day, and that cap rate that's in place, the entry cap rate, it's made up, is no way correlated. I mean, it is somewhat correlated, but it is not the basis and logic of what you should use for your exit cap rate, is what we'll call it. Whether you're actually exiting via a sale, a refinance, or just holding, we'll call it an exit cap rate, okay? So the entry cap and the exit cap are not the same thing. They should not be used, and I see that as a major mistake. I look over my students inside my mentorship, I look over their deals all the time, and they're doing things like, hey, I'm buying this on a 6.87% cap rate, so that's what I'm gonna use. Absolutely not, guys. Do not do that, guys and gals, right? Everybody watching this, do not use the entry and the exit cap rate as the same thing, because the cap rate is really market driven, okay? What that means is the market is in the size of the asset, where the asset is located, and what kind of asset it is, and then what classification of the asset that you're looking at. Everybody knows I love self-storage. If I'm looking at a self-storage in a small town in Georgia, there may only be the facility I'm looking to acquire and maybe 1 or 2 other self-storage facilities in that town. I'm in a town right now where I'm the only self-storage facility in town. So how am I gonna go out and find a cap rate of a competitor that's sold? It might not even exist. So what you have to do is you have to look around other towns or regions of similar size, of similar demographics, and look for what other properties have sold for, right? And then what you wanna do, if you see that, hey, I'm in a town with 20,000 people and the median income there is, $65,000. I want to look for other similar sized towns around the state of Georgia or wherever you're investing. And what I want to do is I want to figure out, okay, what are those trading for? What are those selling on a cap rate basis? And what are other ones for sale for? What are they actually currently trading for? And then here's what I'm going to do, guys. I'm not going to care at all about the cap rate on the entry. And I'm going to add 1 whole point, or as the finance people call it, 100 basis points or bips, okay? What I'm gonna do, let's say that I figure out that, okay, 20,000 people, 65,000 median income, self-storage properties of this size are trading currently on a 6.5 cap. I'm gonna take that 6.5 or whatever I determine that rate to be, and I'm going to add 100 basis points or 1%. So on my exit cap rate, I would use a 7.5 cap rate instead of a 6.5, which is the entry cap. So the reason all this is a liar, why cap rates are a liar, is because you could buy something on a 0, a 1, a 2 a cap rate well below what the exit cap rate should be, and you can still make a ton of money. And the reason you can do that is because of value add. You buy something for $1 million, you blow up the NOI. The cap rate doesn't really matter if you've blown up the NOI. It does to get your value, but you can add a significant amount of value and go from a 6.5 to a 7.5 cap and still make a ton of money. And so I hope you guys found this lesson valuable. If you have any questions about cap rates, I get them all the time. Drop a comment below. Again, like this video, subscribe to the channel, and if you need a copy of my book where we talk about more on cap rates, you can get one of those links in the description. Other than that, I'll see you in the next video.